A huge addition that was made permanent and part of the new One Big Beautiful Bill is a 100% bonus depreciation for any asset placed into service after January 19th, 2025. Previously, it was 40%. So we were at 100% from the Tax Cuts and Jobs Act. We were getting stair-stepped down by 20% per year. 2025 was going to be a 40% bonus depreciation. Now it's 100% bonus depreciation. Why is that so important for all of our entrepreneurs?
Oh my gosh. Well, for multiple reasons. Real estate is the most obvious. The 100% bonus depreciation is going to help folks that are into real estate a lot, but also anything you're buying for your business, equipment and the like, because the limit previously was $1 million. Now it jumped up to $2.5 million, and the phase out used to start at $2.5 million. Now it starts at $4 million. So that means above $4 million, those kinds of purchases, you start reducing the amount of your that you were able to use for 179. So it's pretty cool that has been increased, and there's a lot of different applications as far as this is concerned. You know, vehicles over 6,000 pounds.
Yep.
And as I said, 100% bonus depreciation impacts real estate, but especially the qualified real estate professional. So I don't know if we want to side into that or keep moving on with this.
Yeah, let's talk through it. You teased everyone on the qualified real estate professional status, so go ahead, take that away.
The magic part of that in the tax code, as you know, is that if you're a qualified real estate professional, then you can take passive losses from things like depreciation and actually offset active income. Mm-hmm. That's a pretty powerful thing, because often I know you and I meet entrepreneurs that are like, oh, I want to do a bunch of real estate, cost segs, all this stuff, create all this depreciation and wipe out my taxes. You go, that's great, except you're not a qualified real estate professional. So you have passive losses and you have active income, and those two don't offset. That's a tough lesson that a lot of entrepreneurs have to learn. But if you're a qualified real estate professional, you can take passive losses through things like depreciation, offset active income, and that's magical.
I think data centers is another huge thing, right, where there's huge benefits in the bonus depreciation and being able to write off those server racks, the Blackwells, and all of the NVIDIA chips. And that goes into section 168N. And this is, I think, the biggest, newest addition to the tax code from the OB3. And this is really to drive domestic manufacturing and a massive incentive. And it kind of ties in some of the things we've talked about. But what the new 168N, and it's called the qualified production property, it's essentially saying that if you build a domestic manufacturing facility, and there's some rules around that, instead of writing it off over 39 years, you can write it all off today, which is crazy. So you write it off once you place it into service. And again, normally you're writing that off over 39 years. So you're only writing off around 2.5% per year. And the whole goal here is to really push domestic manufacturing. And this is part of, Trump really trying to onshore a lot of jobs and a lot of industry. And so we'll see. He's using the tax code to incentivize it. Will it work? I guess we'll find out over the next several years.
You can imagine the advantage that you have if you can write off that expense day one. It's a huge advantage cost-wise over someone who might be competing with you overseas. Obviously, you're going to have higher cost of labor and stuff like that, but it's going to be a huge advantage. One thing that I thought was interesting in this part of the bill is you can't have parts, there's certain parts of the building you can't expense. So for example, if you have 80% of the building is production and 20% is offices, you can't write off the offices.
Right.
Stuff like that you need to be aware of, but it's still an enormous opportunity. And I think anyone who's in the space of development like this, I think you should look at this.
Yeah. I mean, and now you stack that bonus depreciation of equipment. So when you're building this building out, if you're doing that qualified production property, right, you can now write off that. Plus then you got to go fill the factory floor with equipment. Well, now you can write off all of that 100%. And then even for the pieces that maybe is the office space, the parking lot, the whatever else is not qualifying, you then do that cost segregation study. And that's where you just start really stacking these strategies. And it's really, again, going to be massive amounts of capital, I believe, flowing into this space, because you can leverage and you can take loans from the bank. And so if we did an example of you take a loan from the bank and you get a 75% or 70% loan to value, you build a $10 million building. Well, if you get a $10 million deduction, that's worth $3.7 million of tax deductions there at 37%. But if you're only putting 30% cash down on $10 million, that's $3 million. So if I'm $3 million cash down, but I saved $3.7 million in taxes in year one, it's just all upside from there. So granted, I have to operate this building. I got to make sure I'm making money in the operations, but by using leverage, that's where you can be, you can pencil these day one potentially.
Because you have to operate it for a while, right? Don't you have to operate it for 10 years?
Yeah, there is a 10-year recapture. So that is a big piece that, they want to make sure that you're not just building these buildings and then shutting them down and writing them off. So there is a recapture that if you do not, essentially if the change in use triggers that, and you recapture it all ordinary income. So yeah, you're going to pay all the taxes back if you don't, put it in use for 10 years there.